Medical Properties Trust, ticker MPW, is currently trading at $10.10 and is 3.95% down from the last close. If we look at the maximum graph of MPW, we can see that it's currently trading at the lowest price since about 10 years. It hasn't traded this low since 2012. Therefore, today I want to evaluate MPW and calculate its intrinsic value to see if it might be a buy. To do this, we will jump over to my spreadsheets where we will use the 9-pillar analysis and we will find the intrinsic value of MPW using the Graham's formula revised, discount cash flow analysis, multiples valuation, and dividend discount models. If we look here, we can see that the total revenue has decreased by about 0.1% and the gross profit has decreased by about 0.5% as well, though the net income has increased by almost 40% since last year, which to be honest is slightly a red flag because I believe that next year this percentage will be negative. We can see that the operating cash flow is 7.4 billion and the investing cash flow is positive 3.4. Normally you have investing cash flow negative, but since MPW has been selling out quite a bit of shares, the positive investing cash flow is from that. We can see that the free cash flow has increased by 184% since 2021 to about $2.82 billion. Again, a red flag because I believe it's going to fall next year. You can see the total assets and liabilities here and the shares outstanding here as well. For the dividends, the current dividend yield of MPW is 11.52%, which might seem like a yield trap, but we will figure that out during the analysis process. You can also see that MPW is currently paying out $0.28 per share, which is a decent amount. Now let's jump to our 9-pillar analysis. First, we want the 5-year PE ratio to be below 22.5. MPW has its PE ratio at about 13.22. 5-year profit margin to be above 10%. It is currently about 50%, so that is a tick as well. Revenue growth over 5 years, 19%. Net income growth over 5 years at about 26.20%. Next, we want there to be a decreasing number of shares outstanding, which is across as in 2022, the number of shares outstanding increased by about 1.5%, which if you look back at statistics, we can see that that is the reason why investing cash flow is positive and not negative. Next, we want there to be less liabilities to assets. We want increasing free cash flow over the last 5 years. It has been increasing steadily. We want the price to free cash flow over the last 5 years to be below 20, and it is currently 11.1. For those of you who don't know, price to free cash flow basically determines whether a company is under or overvalued. If it's above 20, the company is overvalued. Currently, we can see that MPW is certainly not overvalued. We want there to be consecutive dividend growth, which there is. Now we can see that MPW scored 8 out of 9 on the 9-pillar analysis, which is a good score. But why do we even do the 9-pillar analysis? Why don't we jump straight to the intrinsic value? Well, the 9-pillar analysis allows me to see more closer into the company's financials and gives me an idea of how well the company is being run. And in this case, MPW is being run pretty well. But anyways, let's move to finding the intrinsic value. First, let's apply the revised Graham's formula. To do this, we plug in the earnings per share and the 5-year earnings growth estimate to calculate intrinsic value of 9.58. Let's move to the discounted cash flow analysis model. Here I plugged in the free cash flow for the past 10 years and calculated the average growth rate. And based on that and the analysts' growth rate projections, I calculated that the average long-term growth rate would be about 5.3%, as I believe that 2023 won't be an easy year for MPW. I then calculated the present value of the future free cash flow, summed it up, added any cash and cash equivalents, and subtracted any total debt. This gave me an equity value of $24 billion, which I divided by the shares outstanding to get an intrinsic value of $40. Let's move to the multiples valuation model, which is based on comparing companies with similar structures to MPW. I found the stock price of Peak and HR. I then divided by the earnings per share to get a price per earnings of 11 and 31. I then averaged that out and multiplied by the earnings per share of MPW to get an intrinsic value of $31.73. Now let's move to the dividend discount model. Here I took the yearly dividends for the past 10 years and calculated the average growth rate, which is about 10%. But since the dividend discount model does not work when the average growth rate is larger than the WACC, I had to apply an alternative model where I used this year's dividend of MPW, the next year's dividend, the stock price projection for next year, and the WACC as well, to get a discount dividend model price of about $12.50. Now to calculate the real intrinsic value of MPW, take the average of the four valuation methods and get an intrinsic value of $23.53, which is about an 133% difference to the current price. There's no point of applying a margin of safety, as even if we apply 50% margin of safety, the stock will still be a buy. Let's now jump to my Interactive Brokers account and have a look at the analyst's projections. Now we are in my Interactive Brokers account and we can see that the net income before tax should decrease by about 40% in the year 2023 and then slightly increase in the next year 2024. We can also see that the dividends per share should increase by about 10% for the next 5 years until the year 2026. If we scroll further down, we can see that the revenue should keep increasing steadily up to the year 2026, as well as the net debt, which, to be honest, is slightly a red flag. With that, if you enjoy this evaluation, leave a like, subscribe, and leave a comment. Let me know if you are going to be buying MPW stock or if you will wait for a better opportunity.